A very good afternoon to you on the business desk at this hour. The latest BankservAfrica Take-home Pay Index has reported another month of positive gains, registering a 35% improvement in January. This suggests a significant erosion of the purchasing power of salary earners taken off in 2023. Now, while the index notes monthly improvements as inflation moderates, it's highlighted that stormy clouds are on the horizon, particularly for tax-paying South Africans. Now, that's as government's recent decision not to adjust income tax as a bracket for inflation may cause inflation strain. Economist Elize Kruger discusses this with us. Thank you so much for your time, Elize. Some good news, but there is a warning. Let's first unpack what this reading is telling us currently.
Good afternoon to me, Sang. Yes, the BankservAfrica data Take-home Pay Index indicated that salaries did pick up for a third consecutive month in January. So that is good news, compared to a year ago. There's a fairly significant improvement. On the one side, I think we've got less erosion coming from the inflation rate, which, as you know, have been moderating. But on the other hand, the budget did not really contain good news for salary earners. As you alluded to that bracket creep phenomenon that will be at play, not only in this coming financial year, but it seems like for a further 2 years.
Let's delve deeper into that element, Elize, how we get to understand it as ordinary South Africans. There hasn't been an increment on the side of income for quite some time. So to what extent does the latest development coming out of the budget speech bite a little bit stronger?
Yes, so if you look at the decision by National Treasury not to adjust the income tax brackets, you will now find that if you do get a salary increase in 2024, and that salary increase bumps you into a higher income tax bracket, you're going to pay a higher tax rate, and that could easily eat up, erode all of that gains of your higher salary. And that is what we call bracket creep. So you can end up actually with a lower take-home pay compared to what you had before you had your salary increase. That is now in the case where you end up in a higher income tax bracket. And that phenomenon, that policy of government will earn them about 16.3 billion rand in FY25, the fiscal year ending in Feb 25. So that shows you that amount of money is basically subtracted from what salary earners would have taken home if it was not for this bracket creep situation.
It's a tough situation for South African income earners, especially when we get to that dispensation of discussing wage increases, because there could be caution that I maybe do not want to have a change in my tax bracket based on what you've just alluded to. How much of a conundrum does that then put into this particular element of the discussion?
Yes, indeed. I think it will really depend on, how big that salary increase would be and whether it's going to, take a salary earner into that next level. So overall for the economy at BankservAfrica, we do expect that this year could be a better year for salary, increases compared to last year. On the one side, because the economy should do somewhat better in 2024 compared to 2023. Specifically, we're expecting a real GDP growth of 1.3% compared to last year's estimate of 0.6. And that is partly on the assumption that we will also have a better load shedding scenario playing out in 2024. So there's a likelihood for better salary increases in nominal terms, but then you will have this risk of potentially taking home less.
Optimistic sentiment is required in the current landscape, Elize. The near-term outlook on a broader picture, then, what do we attribute this to, especially as the anticipation is that inflation is going to continue dropping and ultimately maybe we would see an adjustment with monetary policy tightening?
Yes, indeed. So I think the two positives for South Africa for this year, on the one side is a further moderation in our inflation rate. So I forecast an average headline CPI at 5.3% in 2024. That is lower than last year's actual of 6%. And then hopefully once we start to see headline CPI dipping below 5% in the second half of the year, we should see the Reserve Bank responding by cutting interest rates towards the end of the year. And on that front, I do expect that we might see like a 75 basis point cumulative cuts in rates by the end of the year. And that will provide some alleviation for salary earners, for households in South Africa that have been very strained given all the sort of fairly significant and difficult economic circumstances.
Lastly, Elize, any risk areas that may be identified at this stage that could be an impediment for South Africa turning the tide in terms of economic trajectory?
The one risk factor that really stands out to me at this point in time is the current weak level of the rand exchange rate. I mean, the rand has slided quite significantly in the past few weeks. And, if that levels continue, it could be a spanner in the works for inflation moderating. Because as you know, rand depreciation would lead to higher imported costs for all things we import. It will also continue to push our fuel prices higher. And that could just be, a very negative environment then for inflation to moderate. So that, I would say, where I see it today, could perhaps be our most, prominent risk playing out. So let's hope the rand could strengthen somewhat in coming weeks.
We cross fingers. Thank you as always for your input. Elize Kruger is an independent economist talking to us about the latest BankservAfrica Take-home Pay Index. It's seen an improvement, but there are areas of risks in the near term.